Journal entries. Journal entries are the way that we record transactions in the accounting records. So we've learned about how transactions affect the accounting equation. You learned about how increases and decreases in accounts are relative to debiting versus crediting an account. So now we put those together into a journal entry. So the example that you see here is a transaction that is happening on October 1st when a business is paying rent. So if you remember your mnemonic, which has to do with which accounts are increased by a debit and which accounts are increased by a credit. So the mnemonic is dealer. D-E-A-L-O-R. D is for dividends. E is for expenses. A is for assets. L is for liabilities. O is for owner's equity. R is for revenue. So what we have when a company is paying rent, we have rent expense. Anytime you are recording an expense, it will be a debit to the expense account. So the account is rent expense and it is being debited for $400. Cash is an asset. Assets are also increased with a debit. But if you're paying cash out for rent expense, your cash is not increasing, it's decreasing. So to show a decrease in cash, you credit cash for $400. This is an illustration of the journal entry that I just showed you to break down the parts of the journal entry itself. So you have the date of the transaction, the account that you're debiting, the account that you're crediting, then the amount of your debit, and the amount of your credit. Recording journal entries. So now we will practice recording journal entries. These are the exact same transactions that we looked at in Chapter 1 when we looked at how transactions affect the accounting equation. So you'll recognize this from the Chapter 1 PowerPoint and lecture. So what we'll do now is take the transaction information, see how it impacted the accounting equation like we saw in Chapter 1, and see how that translates into a journal entry. So on December 1st, Chaz Taylor forms a consulting business named Fast Forward, set up as a corporation. Taylor invests $30,000 cash in the new company in exchange for common stock. So remember, we always look to see what the two accounts are that are being affected and what's happening in this situation. So cash is increasing. We noted that here. So how do we know whether that will be a debit or a credit to cash? We look at what type of account cash is. Cash is an asset. We look at our mnemonic to see where assets fall. Assets are on the side of the T account that are increased with a debit. So we know that we will debit cash. The debit always comes first and it is not indented. So you will debit cash and then you have to have an account that you credit. So obviously here we know if we're debiting cash, then we would credit our other account. But if we did not know that part already and we were just determining whether or not we debit or credit common stock is an owner's equity account. It is increased with a credit. So since common stock is being issued, the common stock account is increasing with a credit. So you credit common stock, and that is for an amount of $30,000. The date of this transaction is December 1st. So this is what your completed journal entry would look like. Transaction 2, purchase supplies for credit. Fast forward purchase supplies paying $2,500 cash. So your two accounts are supplies and cash. When you look at how they affect the accounting equation, you see that cash is decreasing by $2,500. Supplies are increasing by $2,500. So those are both asset accounts. To increase asset accounts, you debit them. So we need to see which of these accounts is increasing. That's what we will debit. It is the supplies account. So you debit supplies. Remember, the debit account always goes first and it is not indented. Cash is decreasing, so you credit cash. The credit comes after the debit and it is always indented. And that's because the credit amount is indented. So you put your debit amount here and then your credit amount is indented because debit means left and credit means right. So the amount of the transaction is $2,500. So we know that assets, any type of asset account, is going to be increased with a debit and decreased with a credit. We know that our supplies are increasing. That's why supplies is debited. Cash is decreasing. That's why cash is credited. Transaction 3, purchase equipment for cash. Fast forward purchased equipment for $26,000 cash. We know that cash is decreasing. Cash is an asset account. So when an asset account decreases, it is a credit to cash. Why is that? Because if you look at assets, assets are increased with a debit, but our asset is decreasing, so it will be decreased with a credit. So we can go ahead and put cash as our credit for $26,000. The other account that we're looking at is equipment. Equipment is also an asset. Equipment is increasing. So assets are increased by a debit. So we will debit equipment for $26,000. Transaction 4, purchase supplies on credit. Remember, credit means there is no cash exchanging hands. Instead, it will be an account payable or an account receivable based on what is happening in the transaction. Whether it is something that the company will be receiving in the future, money that the company will be receiving in the future, that would be accounts receivable. Or if it's money the company has to pay in the future, that is accounts payable. So additional supplies are purchased for $7,100. Instead of paying with cash, the business purchases them on credit and will pay the supplier at a later date. So this will be an account payable. So we see that additional supplies are being purchased. So that will increase the supplies account. Supplies are an asset. Asset accounts are increased with a debit. So that will be a debit to supplies. Accounts payable. Accounts payable is a liability. This payable is increasing because the amount owed to an outside party is increasing. So a liability is increased with a credit. So we have to credit accounts payable. And the amount is $7,100. Transaction 5, provide services for cash. Fast Forward provided consulting services to a customer and received $4,200 cash immediately. So one trick to journal entries is if they involve cash, is the cash increasing or decreasing? If you can remember that cash is an asset and cash increases with a debit, then if your cash is increasing, it will be a debit to cash. And then you automatically know 1/2 of the journal entry, which tells you that whatever the other account is, if there's only one other account, that is the account that you will have to credit. So the cash is increasing, and since they have provided consulting services, their revenue is increasing. So there are lots of different names for revenue accounts. We can just call this service revenue. And the amount is $4,200. Transaction 6, payment of expenses in cash. So we already know there will be an expense and there will be cash. Fast Forward paid rent of $1,000. So if the company is paying cash, that means that cash will be decreasing. Cash is an asset. Assets are increased with a debit. So that means to show a decrease in cash, it will have to be a credit to cash. So credit cash for $1,000. Since you have your credit, you know that the other account has to be your debit. And it's an expense. Expenses are recorded or increased with a debit. So anytime you record an expense, it will be a debit to that expense. So you debit rent expense for $1,000. Transaction 7, payment of expenses in cash. So exact same scenario as before. Now it is just that Fast Forward paid salaries of $700 to its employees. So this is still an expense called salaries expense. Anytime you record an expense, it will be a debit to that account because expenses are recorded or increased with a debit. So you'll debit salaries expense. Remember, anytime you're decreasing cash, it will be a credit. That is because cash is an asset. Assets are increased with a debit, but we're not increasing cash here. We're decreasing cash. So the credit is to cash. And that amount is $700. Transaction 8, Part 1, recording revenue on account. Remember, on account means that there is no cash exchanged. On account means it will be either a receivable or a payable. It will be a receivable if cash will be received later. It will be a payable if cash will be paid later. Fast Forward provided consulting services, so that's revenue, of $1,600, but does not receive cash immediately. The cash will be received in the future. So that means it will be accounts receivable. And we have a revenue account also. So accounts receivable is an asset. Assets are increased with a debit, so we will be debiting accounts receivable. We're also recording revenue revenue is increased with a credit, so we will credit service revenue. The amount is $1,600. Transaction 8, Part 2, Recording Revenue on Account. Fast Forward rents facilities for $300 to a customer for credit. So they are renting a facility out to a customer. So that will be considered rent revenue. Revenues are increased with a credit. So we know that our revenue account will be our credit in the journal entry. So we will credit rent revenue. Accounts receivable is an asset. Assets are increased with a debit. So we will debit accounts receivable for $300. Transaction 9, receipt of cash from accounts receivable. So what this means is that an account receivable was previously recorded. So like in the previous example, couple of examples, we had debited accounts receivable and recorded service revenue. So this was the first part of transaction 8. That's how you initially record a receivable, and that's when the company will be receiving cash in the future. In this transaction, that is when the company is receiving cash toward that account receivable. So the client in transaction 8 pays $1,900 for consulting services. What that means is that the cash is now being received. So we know cash will be increasing. First of all, cash is an asset. Assets are increased with a debit. So you will debit cash for $1,900. Remember, if cash is involved, always figure out whether your cash is increasing or decreasing first. Then you can figure out whether cash is being debited or credited. Once you've got the cash either debited or credited, you know that the other account will be the opposite. So if we're debiting cash, that means in this situation, we will be crediting the other account. The other account is accounts receivable, which will be debited for $1,900. So let's say that you weren't sure about cash. How would you know that accounts receivable would be the credit account? So accounts receivable is an asset. Assets are increased with a debit. But here we are not increasing accounts receivable. We are decreasing accounts receivable because by this payment, we are decreasing the amount recorded that is going to be received in the future. So that is why, since accounts receivable is an asset and it's decreasing, you credit accounts receivable. Transaction 10, payment of accounts payable. So when an account payable is initially recorded, so we're going to say in transaction 4, this is a previous transaction when an account payable was recorded. So the journal entry to record an account payable is going to be a debit to some type of expense or anything like that. And then instead of paying cash, the company records accounts payable to show that they will be paying that amount in the future. So this would be a journal entry that took place previously, and now what's happening is that Fast Forward is paying $900 as a partial payment for supplies purchased in transaction 4. So this would have been a debit to supplies since that's what they were buying. So they got $900 of supplies, they increased their supplies and credited accounts payable. So now if they're paying on that account payable, you have to do the opposite because this increases accounts payable. What we need to do is decrease accounts payable. So that will be a debit to accounts payable. Another way you can look at that is accounts payable is a liability account. You are decreasing a liability account. Liabilities are increased with a credit, which means that they are going to have to be decreased with a debit. So debit to accounts payable. They're paying that in cash. Anytime cash decreases because it's an asset, assets decrease with a credit. So you credit cash and the amount is $900. Transaction 11, payment of cash dividend. So a dividend is when a corporation pays out cash to its owner. So Fast Forward declares and pays a $200 cash dividend to its shareholder. So those are the two accounts affected. Cash is being decreased because it's being paid out. So we know that that will be a credit to cash because cash is an asset and assets are increased with a debit. So since cash is decreasing, it decreases with a credit. The other account that is affected is the dividends account. Dividends are recorded with a debit. So debit dividends, $200, and credit cash, $200. So this shows the general journal. The general journal is a complete listing of every transaction in a journal entry. So you have journal entry 1, journal entry 2, journal entry 3, and it just continues on and lists all the journal entries. So here are the steps that we have taken so far when we look at transactions. So step 1, identify transactions and source documents. Source documents are things like a receipt, an invoice, a bank statement, a purchase order. So identify transactions, then analyze transactions using the accounting equation. Next, record the journal entry. And so the next step is to post entries to the ledger. So we will look at that in the next part.